Hi, my name is Spencer Correnti. I run Alkaline Advisors, and today we will be reviewing our premium mixed use acquisition model. So what we're going to do is run through this in hopefully 20 to 25 minutes. I'm going to start with a very broad overview of everything inside the model. Then I'll dive a little deeper into each individual tab. So really appreciate you joining us, and let's begin. So to start, this is a fully dynamic financial model. What does that mean? That means that there are input cells. So you put your information in these blue tabs. You'll see there are blue cells in these blue tabs. You populate the blue cells and then everything else updates automatically. So we'll start with the inputs tab. This is where, let's say, 90% of the inputs are housed. And again, we're just going to run through this very quickly to start, but you could see we have return metrics, general project inputs, multifamily operating inputs, commercial operating inputs. Then we also have commercial rent roll over here, which we'll get into in a moment. We have project level taxes and reserves, financing inputs, the SOFR curve. Next, we have the commercial rent roll tab. This is where you will key in your lease assumptions for the commercial segment of your mixed use project. Here we have the in-place rent roll to have more tenants. Then we have the market leasing assumptions or second generation rent roll. Next, we have the partnership returns tab. This is where we do the GP-LP splits and the hurdles, compounding frequency. Next, we just have general information on the multifamily rent roll, which is taken from the inputs tab. All of those inputs will roll into the CF tab, which stands for cash flow. You can see it segmented out by categories. We have acquisition costs up top. Then we have the multifamily operating statement and the commercial operating statement segmented out. Both of those will combine into, you guessed it, the combined operating statement. Underneath, partnership return or partnership equity, then pref equity if there is any, acquisition loan, perm loan, operational reserve, sale value, contribution distribution section, and then cash flow section. This levered cash flow line is actually what flows into the partnership returns tab. That's how we distribute between GP and LP. Next, we have the annual cash flow. This is the monthly cash flow, but annualized. There you go. This was lagging. The annual cash flow, or the monthly cash flow, but annualized. Then we have general loan amortization tables. Then we have our investor summary. This is our investor summary. You can PDF it, print it out, send it on over to whomever you'd like. But here, very quickly, we just have different key metrics and assumptions, charts and graphs, snapshots, and then an annual summary. Zoom back out a little bit. And finally, we have our lender summary. Okay, so with that brief 3-minute overview on the model, we are now going to dive a little deeper into the inputs tab. Okay, so to start, you'll see this segment is called project returns. On the left, you'll see the property level returns, and on the right, you'll see the partnership level returns. Unlevered is the property level return without debt. Levered is the property level return with debt. The GP return is for the GP. The LP return is for the LP. You'll notice we have profit, IRR, and equity multiple at each level. And you can see whenever you change an input in the blue cell, this will automatically recalculate all of the profit, IRR, and equity multiple figures for each of these levels. So let's say we want to sell the asset in month 60. You can see how everything updates automatically. Over here, we have some general project information. This acquisition value, this is how we are deciding what to acquire the asset for. So given the NOI, we can choose, well, a couple things. First, we can choose, are we going to spend a fixed dollar amount, as in a purchase price? Are we going to spend a purchase price per square foot amount? Or are we just going to take the cap rate of either the in-place NOI, the year 1 NOI, the year 2 NOI, or the stabilized NOI to give us the value of the asset in which we are going to purchase the asset for? So if we say we want to take a 7% cap rate at the stabilized NOI, then we're going to take a 7 cap of the NOI at stabilization, and this will then require us to purchase the asset at $33 million. Similarly, 7 cap, that will give us a purchase price of $30 million. Okay, so let's keep going. We can choose the closing costs, acquisition fees, any CapEx we have over here. We can load in project CapEx, generally speaking, what the total budget is, when are we going to start incurring those costs, when will those costs end. In terms of the valuation at stabilization and valuation at sale, we've broken it out by multifamily and commercial, so you can actually hit the multifamily NOI and the commercial NOI separately with different cap rates, and you can also choose, let's say at sale, what NOI do we want to pull at the multifamily level? We can choose the trailing 12, the forward 12, the trailing 3. Same thing at the commercial level, the trailing 12, the trailing 3, or the forward 12. And we can say we want to hit the multifamily, let's say with a 6 cap, and the commercial NOI with a 6.5 cap. And then also selling costs. What percent of the value are we going to allocate to selling costs? Next, we'll go to the multifamily operating input section. Here you can choose however many units you have of each unit type. You can also go more granular and outline each unit individually, the size of the units, the current dollar per unit per month for in-place rents. Then you can load in the market rent or the post-renovated dollar per unit per month value. And then we can choose how many of the initial units we're renovating. We can choose to renovate all the units. We can choose to renovate none of the units. Either way, whatever you choose, you can then say that if there is renovation, and let's say in this scenario we'll renovate 20 of the 50 units for each, we can choose how much money we're spending to renovate each individual unit. We can choose when the renovations will start, and then we can choose how many units per month we will renovate. From there, we will allocate the renovated units from month, in this case, let's say that for studios, in month 2 is when we're going to start the renovation. We're going to renovate 10 units per month. So if we renovate 10 units in month 2, we'll renovate 10 units in month 3 to get us to the total of 20 units renovated, which means that our renovation end month is month 3. And because of that, you can see that's when we're done renovating for the studios. Whereas for the 2 bedrooms, we say we're going to renovate 3 units a month starting in month 2. So our final month of renovation is going to be month 8. So in this scenario, we're going to say that we are stabilized in month 8 because we're assuming that's when all of our units are back online at the market rate after renovation. So then we have some other income over here. You can fill this out accordingly, and then you can toggle between how the other income comes through. If it's on a monthly or a per unit basis, you can choose if it's coming in across all units or just occupied units. So here you could do dollar per unit per year, dollar total per year, dollar per unit per month. And if you toggle this, the amount that you key in will change as well. Similarly, we have the same thing for expenses. And then over here, we have some rent growth, loss to lease, vacancy loss, concessions, and then other rent loss. And then we have reserves. Up next, we'll go through the commercial operating inputs. I'm actually going to skip over to the commercial rent roll tab so that we can talk about the actual lease agreements and leasing assumptions for each tenant before we go back to general other income, reimbursable expenses, non-reimbursable expenses, and rent growth and loss, generally speaking, on a market level. And you'll notice these are very similar to the multifamily ones. You can key in whatever you'd like, but in terms of how it's allocated, it's per square foot, so per rentable square foot, whether it's total or occupied. So now we're going to hop into the commercial rent roll tab. Here we have built out this matrix that allows you to analyze the individual units as it relates to what their leasing assumptions are. And then we can also say, all right, well, what does the second generation rent roll look like? Otherwise known as the market leasing assumptions. And these are what will roll into place after your in-place tenants expire. So here you'll see for in place, you can choose whether the suite or the tenant is in place or it's vacant. If it's vacant, you can choose how many months of downtime you're going to need to lease up this space. We'll keep this one as vacant for now and change all the other ones to in place. So here you can choose what the lease term looks like, right? How many months will the tenant be in place from the time that the lease starts? What's the rent per square foot per year figure? Rent growth frequency, how frequently are we escalating rents? Then we have the first escalation after month X. So here you can toggle in however many months after the lease start date is going to be that first escalation. Then thereafter, the rent will escalate either 12, 24, 36, 60 months, or you could say flat and there will be no escalation. Are there any months of free rent? What does the tenant improvement per square foot look like? What do the vacant leasing commissions look like? For recoveries, is it going to be triple net, base year, gross, or fixed? If we choose triple net, for instance, you can choose what percent we're going to be recovering. If it's base year, you choose the base year. If it's gross, it's just the gross amount. And then if it's fixed, you can actually key in a dollar amount over here. Similarly, we have second generation rent roll. Here we have retention ratio. So we're saying what is the percent likelihood that the tenants will remain in place and renew versus having to go out and find new tenants. If you do have to find new tenants and the tenant turns, what is that estimated downtime going to look like between the two tenants? Then we have the market leasing assumptions for lease term, the current rent per square foot per year, annual growth percent, new free rent, renewed free rent in terms of months. What is the new tenant's TI per square foot versus if a tenant renews, what does their TI per square foot look like? Same thing with leasing commissions, if it's a new tenant versus a renewal tenant. And then we have the recoveries as well. So with that, we'll go back to the inputs tab. And I don't think we have to spend too much more time on the commercial operating inputs. Again, it's very similar to the multifamily operating inputs. Next, we'll go to the project level taxes and reserve section. So here we'll start with the operating reserves. What we're doing on a project level is if there's operational shortfall, let's say we have vacant tenants on the commercial side, and let's say we're renovating and doing unit turns on the multifamily side, well, we might have some operational shortfall that's not capitalized. So what we can do is a few things. We've built this out to show, okay, based off of, let's actually make this equity for now. Based off of the project, what is the operating shortfall we have? So it says cash flows available for reserves. We have 24 million, which we'll get into in a second. And it says additional operating shortfall right now, 47,000. So given the numbers and assumptions we have keyed in here, we are saying that there's $47,000 of operational shortfall. By toggling equity, we're choosing to just come out of pocket to pay this $47,000 of operating shortfall. Now, we're also giving you the opportunity to say, well, what if we don't want to come out of pocket for this equity? What if we want to sweep cash flows from operations? If the shortfall happens, we do have additional cash flows, we can sweep some of those cash flows to then cover the shortfalls further down the line. So if we toggle operational cash flows, in this scenario, what we're saying is we want to sweep 20% of all operating cash flows. We're not going to sweep 20%. We're just going to sweep as much needed. In this case, that's 0.8%. So if we do, let's say 0%, you'll see coming out of pocket, 47,000. But let's say we sweep 20%, we can sweep 10%. Actually, in this case, because we're sweeping 10% of every month's cash flows, and the operating shortfall happens within the first few months, which if we go here, and we go to operational reserves, you'll see it's happening in month 3. And then we have some more reserves that we're holding because there's more shortfall in month 14, which we'll get into in a moment. But let's just max this out to month 20, or I'm sorry, 20%. We're actually we're covering all of the operational shortfalls that we have. So we never have to come out of pocket to pay the shortfalls. Similarly, if we don't want to ever sweep operational cash flows, we could say, hey, let's just sweep from refi. If we just sweep from refi, you'll see we have nothing swept at operational cash flows. Here we have about 0.2% swept at refi. But because there are some operational cash flow, because there are some shortfalls before our refinance date, we actually need to come out of pocket some equity to cover the 15,000 of shortfall that happens before refi. Now, what we can also do is toggle operational cash flow, ops cash flow, and refi. That way, we're saying we're sweeping cash flow from operations and from refi. We can go through this in more depth later, or if you have questions, feel free to reach out. But next, we'll go to the taxes section. So we built this tax section out so that you can analyze taxes in 2 ways. The first is you can just manually input the tax figure per year up through year 5 and then grow year 5 at X% per year thereafter. Or we can toggle this to goal seek. And if we goal seek, we're actually using an iterative type of calculation, but we don't have any circular references or macros in the model. So we have to iterate manually, or I guess we have to iterate with an Excel function called goal seek. So we explain exactly how to goal seek here. And I'll briefly explain what the goal seek means. Essentially, what we're doing is we're saying we're taking 1.2% of the value at stabilization and the value at sale. And the value is based off of the NOI, right? Because we're capping the NOI. Again, it's the value based off stabilization using these figures here, and the value at sale based off of NOI, based off of these cap rates. But essentially, in order to calculate the value, right, you need to understand the NOI and cap that NOI. But in order to understand the NOI, you need to understand how taxes impact the expenses, because to calculate NOI, it's revenues minus expenses, right? So it's circular, because in order for you to understand the NOI, you need to understand taxes. In this case, we're saying we need to understand the value of the asset, but the value of the asset is determined by the taxes. So it goes back and forth. So essentially what we're doing is we're running a calculation in Excel through GoalSeek, which allows us to iterate until we get as close as possible to understanding what the value of the asset is and the value of the taxes are by going back and forth very quickly. So here what we can do is go to GoalSeek instructions. So we can go to ribbon bar, which is up here. We can go to data. We can go to what if analysis. Then we go to GoalSeek, right? It's explained there. Then let's start with this box. It says A, set cell field should be set to the red cell on the left. So we set cell, right? Set cell. To value. B, the to value field should be set to 0. So we set to 0 by changing. And it says C, by changing this blue cell, right? So then we click OK, and then boom, that updates, and we're good. So let's do what if analysis again. Let's do goal seek. We're going to do set this cell to 0 by changing the blue cell. We iterate, boom. Now it's updated and all of the formatting went away. That's conditional formatting. Next, we have the financing inputs. So here we have an acquisition loan in play. You can toggle yes, no, whether or not you want to have the acquisition loan. Assuming you do, you can choose what is financeable and what's not financeable. So the purchase price we're saying is financeable. But in this scenario, we're saying that the closing costs, acquisition fee, project CapEx, and unit renovation CapEx is non-financeable. But we can also toggle that to yes, and then all of that would be financeable. We can choose the LTV. We can choose whether the loan type is fixed or floating, what the amortization period is, what the interest only period is. If it's a floating loan, we're tying it to 5 points over SOFR. This is the SOFR table down here. We just drop it in from Chatham Financial, which you can pull directly from these links up top. Then we have, before perm debt, we have pref equity, otherwise known as, you could say, this could also be known as mezz debt. What you do here is you toggle yes. If you toggle yes, that means you have mezz debt or pref equity. You can key in the amount you have, whether their upfront fees are paid current or accruing, what that percentage is, what the exit fees are, if there's any current pay, so any interest that needs to be paid, whether or not you have cash flow, or if there's any accrued interest, so interest that's paid if you do have the cash flow when you have it, or if you don't have the cash flow, it's just accruing and compounding until you have the cash flow to pay that down, or when you pay this off completely, it's paid off as part of the principal. So then you can choose if there's a minimum equity multiple and what percent of free cash flow are you using to sweep this. Right now, we say there is no minimum equity multiple, so there's no additional capital needed at payoff. Let's say there is a 1.2 minimum equity multiple. Well, when we do go to pay this down, we need to come out of pocket an additional $94,000 to pay off that minimum equity multiple. Next, we'll go to the perm loan. So if you are going to renovate and then sell and use proceeds from sale to pay off the acquisition loan and pref equity, if there is, you can toggle perm loan to no. But if you do want to have a perm loan, you can toggle this to yes, choose the LTV, choose the the min DSCR, and choose the min debt yield. You can choose what month you are going to be refinancing and then what the value of the asset is at refi. So here we're going to choose right now, we're going to take the cap rate at month 15 of the forward 12 NOI using a 6 cap to derive the value, but you can also take a dollar per unit and dollar per square foot in order to value the asset. So we'll go back to cap rate. Month 15 is when we're refining, but let's say we want to refine month 8. This will show up as red just because it's showing that you're stabilized in month 9, but you want to refine month 8. Another cool feature on this perm loan section is that you have a min DSCR parameter. So right now we're saying we want a 70% loan to value, but there is no minimum debt service coverage ratio. And at a project level, our debt service coverage ratio is 1.18. If, let's say, the lender says there's a minimum of 1.2 debt service coverage ratio, well, then we will size the loan to factor in this 1.2 DSCR. So now our LTV is actually 69% and not 70, right? If we brought this up to 1.25, it dropped to 66.2% and not 70, automatically sizing the loan because we need to fit into our lender's minimum debt service coverage ratio parameter. So that is, and then similarly down below, we have amortization period, IO, floating or fixed in terms of the interest rate. And then next we'll go to the sensitivity analysis. So here we are giving a 2 variable sensitivity analysis where we are sensitizing the exit cap and we are sensitizing the sale month. So in this scenario, I believe we are just sensitizing the exit cap of the multifamily, but we can update that to sensitize the exit cap of the commercial as well. Or if you want to do blended, we can do that too. Just reach out and we're happy to update accordingly. But here you can toggle between what are we sensitizing, the profit, the IRR, or the equity multiple at a project level, at a GP level, or at an LP level. So in this scenario, we're going to analyze the LP profit sensitivity. So you'll see this is red. That means it's not updated. We have instructions down here. Note if return cell is red, update data tables, go to formulas, calculate now. So we go to formulas, we click calculate now. It's iterating. Once it iterates and calculates, you'll see the red goes away, the yellow goes away. Now this is accurate. Okay. So next, what we're going to do is we're going to skip the commercial rent roll tab because we already were there. We are going to go to the cash flow tab before we go to the partnership returns tab. So in the cash flow tab, you'll see we have different segments for all of the sections of the analysis. So up front, we have acquisition costs, and you can see this is a monthly model, and it goes out to 180 months or 10 years. So actually, that would be 15 years. So here, what we are doing is we're showing on a monthly basis, what costs are you incurring? So at an acquisition level, this is what we're incurring. Then we have the operating statement. As we said before, we've broken it out so you can see just the multifamily on its own, the occupancy schedule, the revenues as it comes in, loss to lease, physical occupancy is calculated here. Then we have other losses, right? Vacancy, concessions, other rent loss. That gives our total rent income. And then we have the economic occupancy percentage. Underneath, we have other income. Then we have operating expenses. Finally, we have NOI, and then adjusted via the replacement reserves to give us our net cash flow. Underneath, we have something similar for the commercial operating statement specifically, right? We are separating it out so you can see just what the occupancy schedule looks like at a commercial level. Same thing with revenues. Then we have other losses. We have operating expenses. We have reimbursements or recoveries up here. We have the non-reimbursables sectioned out, but we don't have any in this example. Then we have TIs and leasing commissions. And then underneath, we have the combined operating statement. So this is a more digestible snapshot that takes into account both the multi and the commercial. Underneath that, we have the capital stack. So here we have partnership equity first. We're drawing the partnership equity. Then we have the pref equity. And then we have the acquisition loan coming in times 0. Then we have the perm loan. In this scenario, the perm loan comes in at month 15. And it'll stay in until we sell in month 120. And we're using proceeds from sale to pay off this perm loan. You'll notice the operational reserve section, right? When we start, we start sweeping cash in month 16, and we're reserving some of this cash. And then in this scenario, we don't need to pay anything off. So actually, we have a shortfall of $15,000 in month 52, probably on the commercial rent roll with tenant improvements or leasing commissions, if I had to guess. But we don't have to come out of pocket because we've reserved this capital already. We talked about the sale value. Then we break our model out into contributions and distributions. So this is what I was talking about before. We have contributions at a acquisition level. So what are we spending for the what are we contributing initially to acquire the asset? And then are there any operational shortfalls? If we go back to the inputs and then go to, for instance, operational shortfalls, but operational reserves, but turn this to equity and go back to the cash flow, then you'll see we have $15,000 worth of shortfall. And that $15,000 worth of shortfall happens in month 52. So we're going to cover that $15,000 worth of shortfall here. And we can solve whether or not, because we said we want to come out of pocket in this scenario by toggling equity, we can say whether we want to raise that equity up front or if we want to just incur it at month 52 and come out of pocket in month 52. Similarly, we separate the distributions out into two sections. One is distributions from operations, and then one is distributions from refi and or disposition. So that would be whether when you're refinancing or selling when the capital comes into place. So all of these cash flows are calculated and ultimately condensed into two line items. One is unlevered cash flow. So that is the line item assuming you don't have debt. And then the other is levered cash flow. That is the line item assuming that there is debt. What we do is we take the levered cash flow line, we flow that directly into the partnership returns tab. So on this partnership returns tab, we are calculating all the inflows and the outflows, right? So with the outflows, we are determining whether we want to calculate all those outflows, right? So all the contributions, what are we spending? Do we want to front load that and say, hey, we want to earmark all those dollars up front and say we're more or less spending them in time zero? Or do we want to toggle that to incurred and say we're only spending them when we need to at a project level? Most likely it'll be spent up front, right? You'll earmark them up front. And in that scenario, you'll toggle up front. You can choose what percent of the capital is being contributed, of the equity is being contributed by the GP versus the LP. So here we have a 90-10 split. Then you can choose the hurdles between the GP LP. You could say that the equity is returned and then the profits are split pari passu, which means it's just even based off of what the GPs and LPs contributed. You could say there's one hurdle, meaning that after the LP receives their 8% preferred return or whatever you'd like this to be, then thereafter there's a promote of, here it's 10%, but you can make this 20% or whatever you'd like to the GP. And then thereafter, then the LP would receive an 80% promote. The LP would receive essentially 80% of the promote, which means that their distributions, because the GP put in 10% of the equity, the distributions would be split 28% to the GP, 72% to the LP. And happy to explain the difference between just a straight split in terms of distribution or what the promote means and how you're promoting based off of the equity or outstanding versus just splitting evenly. So I can explain this in more detail if you'd like, just reach out. But here you can choose between just a strict 80-20 split or a 20% promote based off of the equity that the GP putting into the deal. So next you have the compounding frequency. We can choose if the pref is compounding annually, monthly, or there's no compounding. Then we have the distribution frequency. We can choose when we're making distributions to the LP. Are we distributing capital monthly when we have it, quarterly, or annually? And then finally, or I guess quickly, we'll go to the multifamily rent roll tab. Here we are giving a snapshot of the multifamily unit matrix. We have the rent roll. We have the renovation schedule. We have the CapEx schedule. We have the non-renovated market rent per unit. We have the renovated market rent per unit. And again, that's what's used to do all the calculations in the cash flow tab. We can hop to the annual cash flow tab. This is going to be identical to the monthly cash flow tab, but this is annualized. We have the loan amortization tables. Here we separate it out by acquisition loan and then perm loan. This is all conditionally formatted, so if the refi happens later, these gray cells will ungray and you'll be able to see what the actual information is underneath. Then we have the investor summary. The investor summary, again, it's a really great 3-page PDF snapshot. You can just print it out and send it directly to whomever you'd like. We have key metrics at different time periods, so at stabilization, at refi, at sale. Deal notes, these auto-populate. The returns auto-populate. Sources and uses auto-populate. The charts, the graphs, those all populate automatically. Same thing with the in-place versus the market rent as it relates to the tenants over here. In-place versus renovated rent as it relates to the multifamily. So this is commercial, this is multi. We have some acquisition loan notes, perm loan notes. Sensitivities will update automatically. Operating statement will update here at a commercial level. Then you have stabilized snapshot in month 9 versus the snapshot at sale in month 120. And for instance, if we change the sale month to month 110 and then go back to the investor summary, this will update to month 110. So everything updates automatically. Oops, let's go back to the investor summary. And then we have the annual snapshot down below over here too. And then finally, we have the lender summary. So the lender summary, it's going to be another general summary that you can send directly to your lender, and it's going to be more lender focused. So it's going to have the debt terms from the lender's perspective. But similarly, you have the sources and uses, the charts, the graphs, snapshot of the property at takeout, so that the lender who's providing the acquisition loan knows how they're going to be taken out, what the metrics are, and of course, they'll dive a little deeper if it's something that they are interested in. So with that, we are done reviewing our mixed use acquisition model. Really appreciate your time. If you have any questions, please reach out. We can customize anything. Thanks again, and we will see you next time. Appreciate it.